London is flashing a silver stress signal, and you will not see it if you only stare at the spot chart. The spot price can look calm while the real market is already tightening underneath it, because the first thing that breaks in a commodity is not the headline price. The first thing that breaks is immediacy. The cost of getting metal now in the right place, in the right form, through a channel you trust. That hidden cost has its own price. It shows up as rent, the rent you pay to borrow silver, the rent you pay to deliver silver, the rent you pay to turn a promise on a screen into a bar that arrives on time. And when that rent spikes, it is not a trivia fact. It is the market telling you something simple and brutal. Silver can exist somewhere and still be unavailable where it matters. If you stay to the end of this episode, you will know exactly what this signal means, what can cause it, what confirms it, and what is just a temporary technical squeeze that looks dramatic but fades. You will have a short checklist of dials to watch so you can see silver stress early before the loud headlines and the late panic. If you want more episodes like this, subscribe. This channel is built for calm, long-form investigations, not slogans. And share this with a friend who only watches the spot chart, because the chart is usually the last place the truth arrives. Now let me take you into the part of the silver market that most people never think about. Picture a vault door, not as a metaphor, but as a real steel door with real schedules behind it. Picture trucks that have to arrive, paperwork that has to clear, bars that have to meet standards, warehouses that have to release inventory, a chain of permissions and procedures that turns metal into deliverable metal. That chain is the silver market, not the memes, not the hot takes, not the daily candle. And the silver market does not break when the world runs out of silver. It breaks when the world runs out of deliverable silver right now. Right place, right form, right channel, right time. This is why people keep getting shocked by silver, because they think supply is a number. Supply is not a number. Supply is a system, and systems fail at the bottleneck. So what is the signal London is sending? In plain language, it is this. The cost to borrow silver, short term, suddenly becomes expensive. The market starts charging a high rent for access to metal. When that happens, it is usually because someone needs silver now, and the system is not able to mobilize enough without paying up. That rent is often referred to as a lease rate. You do not need to love the term. You just need to understand the function. If you borrow cash, you pay interest. If you borrow silver, you pay rent. If rent is low, silver is easy to source. If rent spikes, silver is hard to source at the margin. And margin is where price lives. Now, before your brain tries to turn this into a conspiracy movie, take a breath. A spike in the rent to borrow silver does not automatically mean the world is out of silver. It does not automatically mean a permanent shortage. It does not automatically mean the price must go straight up. It means the market is stressed in a very specific way. It means immediacy is being bid. So the correct response is not panic. The correct response is investigation. Why would anyone borrow silver? Because the silver market is full of obligations that require metal, not opinions. A refinery needs feed, a fabricator needs input, a dealer needs inventory, a short seller needs metal to deliver. A trader needs to make good on a promise. A participant needs to settle. When a settlement deadline approaches, or when a delivery window matters, a participant may borrow silver to bridge the gap. They borrow now, deliver now, and plan to replace later. In a loose market, that bridging is cheap. In a tight market, the bridge toll rises, and that toll is the signal. Now, here's the second idea you must understand to make sense of London. Silver is not one giant global pool where every bar is interchangeable at every moment. A bar in one place is not automatically a bar in the place you need. A bar in one form is not automatically a bar in the form you need. A bar that exists on a balance sheet is not automatically a bar you can mobilize quickly. This is the difference between existence and availability. So why does London matter? Because London is one of the central hubs where a huge amount of bullion trading and settlement happens outside the exchange screen most retail traders watch. London is where big players clear, lend, borrow, swap, and settle in ways that do not look like a simple futures chart. If that hub feels tight, the whole system can feel tight. Because London is not just a location, it is a plumbing junction. And at a junction, pressure changes propagate. Now imagine a city water system. You can have a reservoir full of water, but if the pipes are clogged, you still cannot get water to your building. That is silver. You can have silver in the world, but if the deliverability pipes are clogged, you still cannot get silver where the obligation is due. The spot chart does not show you the pipe pressure first. The rent shows you the pipe pressure first. So when the rent spikes in a major hub, the market is telling you the pipes are strained. Now we have to get even more precise. What could cause those pipes to strain? There are structural causes and there are technical causes. A structural cause is persistent. It reflects real tightness in availability. A technical cause is temporary. It reflects timing, balance sheet behavior, and short-term collateral dynamics that can reverse quickly. Your job is to learn the difference, because silver traders get wrecked by confusing a temporary spike with a permanent regime shift, and also by dismissing a real regime shift as just another blip. So let us walk through the most common drivers of a rent spike, one by one, in plain English. First driver, settlement urgency. If a large obligation is due and the easiest metal is not available, participants bid for borrowable metal to meet deadlines. That raises the short-term rent. The key here is urgency. The demand is not for silver in general. It is for silver now. Second driver, location mismatch. Silver can be sitting in one venue while the obligation is in another. Moving metal is not frictionless. It has shipping time, insurance, paperwork, and sometimes it has rules that make it slower than outsiders imagine. When location mismatch is high, rent can spike in a tight venue, even if the global total looks comfortable. Third driver, form mismatch. A deliverable bar is not just any bar. Standards matter. In a tight moment, the difference between a bar that qualifies and a bar that does not qualify becomes expensive. Rent rises for the right form. Fourth driver, balance sheet timing. This one is boring and powerful. Around certain calendar windows, financial institutions manage their balance sheets more tightly. They reduce certain exposures. They become less willing to intermediate. They pull back from lending. When intermediaries pull back, rent rises because the system loses lubricant. Fifth driver, collateral stress. Borrowing metal is not only about metal, it is also about financing. When collateral becomes scarce or when funding markets tighten, participants become less willing to lend and more desperate to secure what they need. That can produce a sharp, sudden rent spike that can later normalize when funding conditions ease. Sixth driver, concentration of availability. Even when silver exists, it may be concentrated in hands that are not willing to lend at that moment, or not willing to lend without high compensation. Availability is not only physical, it is willingness. When willingness drops, rent rises. Now notice what all these drivers have in common. None of them require the world to run out of silver. They require only that the system cannot mobilize enough deliverable silver at the margin on the timeline demanded without paying up. That is why this signal is so useful. It tells you when the market is paying for immediacy. Now, let me hit you with a ledger beat that will make this unforgettable. You think you own silver at spot, but when you actually need metal, the market may charge you rent, premium, and time. Spot is the poster. Immediacy is the ticket price of the door. And in a stress moment, the door price can rise while the poster price looks calm. This is why people feel like silver is rigged. It is not always rigged. It is often simply constrained. Now, we bring this back to London again, because the moment you grasp this, the next question becomes obvious. If rent spikes in London, why do we care about the rest of the market? Because this is how stress transmits. Rent spikes first because the first fight is for access. Then spreads widen because intermediaries demand more cushion. Then dealers tighten terms because inventory is harder to replace. Then premiums rise because buyers pay for certainty. Then the narrative catches up because people finally notice. Then spot moves violently because paper markets respond fastest to attention. So rent is early, spot is late. Now, there is one more piece you must understand to avoid being misled. A rent spike can be a flare or a fire. A flare burns hot and fades quickly. It is often tied to timing, balance sheet windows, or a short-lived settlement rush. A fire spreads. It persists. It shows up in multiple places at once. It does not disappear when the calendar turns. So how do you tell the difference? You do not guess. You look for confirmation. Confirmation comes from persistence and from correlation across the plumbing. If the rent spikes and then normalizes fast with no lasting tightness in physical premiums, no lasting dislocation, and no lasting change in delivery conditions, you likely saw a flare. If the rent spikes and stays elevated, and you see it paired with stubborn physical premiums, tighter delivery terms, and persistent dislocations between venues, you may be watching a fire. Now, here is where most people get tricked. They see the rent spike and immediately conclude that spot must explode. Sometimes spot does explode. Sometimes spot drops first because the paper market is crowded and a violent move triggers risk tightening and forced liquidation before the physical. Tightness can express itself in the headline price. Silver is a market that can be physically tight and still crash on paper because paper is driven by leverage and liquidity. A leverage purge can overpower physical signals temporarily. That is why you do not use this signal as a one-button trade. You use it as an early warning of conditions that can create volatility and dislocation. Now, we are going to walk into the second half of the plumbing because rent is only one part of the signal. The next part lives in spreads. If the market is paying up for silver now, it often shows up in the relationship between near-term contracts and later contracts. It shows up in whether the market is willing to pay more for immediacy than for future delivery. In a calm market, the curve usually reflects storage and financing. Future delivery can be more expensive because you are paying the carry cost. In a stressed market, the curve can invert in places. Near-term delivery becomes more valuable than later delivery. The market is telling you it values now more than later. That is a giant clue. And it is a clue that many people miss because they only watch the spot chart and ignore the shape of the market. Now, one more calm reminder, none of this is a guarantee of a permanent shortage. It is a map of stress. And stress is the precondition for the kind of silver moves that look like they happened overnight. Now, if you are still with me, you are already ahead of most people. So do me a quick favor, hit subscribe, because this is the part of the episode where we stop describing the signal and start giving you the exact checklist that tells you whether the market is experiencing a technical squeeze or a structural squeeze. And share it with a friend who thinks silver is only about the daily candle, because the daily candle is not where deliverability gets priced. Now, here is the key question that opens the next layer. When the rent spikes, who is paying it and why? Are they paying it because they are hedging and managing balance sheets around a calendar window, or are they paying it because they cannot source deliverable metal without paying up? That difference is everything, because if it is calendar timing, the spike can fade. If it is deliverability stress, the spike can become a recurring theme, showing up again and again, each time the system gets tested. So the next step is to identify the pressure points that force real deliverability stress and the ones that create temporary optical illusions. And once you see those pressure points, you will understand why silver can feel abundant and scarce at the same time, and why London can quietly lead the entire market without most people realizing it. So let us separate those two worlds now, because this is where your edge comes from. A temporary optical illusion usually has a clock attached to it. It clusters around specific calendar windows. It spikes fast, then collapses fast. It looks dramatic on a chart of borrowing costs, but it does not leave long fingerprints across the physical chain. It is a flare. A real deliverability squeeze behaves differently. It does not care about a calendar page. It returns again and again because it is rooted in frictions that cannot be solved in a week. It spreads across the plumbing. It does not just spike, it persists. It is a fire. Here is how you tell them apart without needing secret information. You build a simple confirmation stack. One signal alone is never enough in silver. Silver will humiliate you if you trade it like a single metric, so you use a stack. First, confirmation is persistence. If the rent to borrow silver spikes and then stays elevated beyond the obvious timing windows, that is your first clue that something is constrained. If it normalizes quickly, that does not mean the market is safe, but it does mean the spike might have been mostly technical. Second confirmation is the curve. If the market is truly paying for silver now, the near end of the curve starts behaving differently. The market begins pricing now as more valuable than later, not as a philosophical statement, as a cash statement. The system is telling you that time has become expensive. Third confirmation is spreads and conversion costs. When the market is stressed, the price you pay to transform one form of silver exposure into another form of deliverable silver tends to widen. The street starts charging a toll for getting metal where it needs to be. That toll is the market admitting friction. Fourth confirmation is physical premiums, not a one-day retail spike. Persistent premiums that survive the news cycle. Premiums that remain stubborn even when spot tries to cool off. Fifth confirmation is delivery behavior. If sellers start extending timelines, tightening terms, or quietly rationing, that is not a meme. That is a supply chain response. Sixth confirmation is accessibility of inventory. Inventory headlines can lie because they treat all ounces as equal. But in a squeeze, the only ounces that matter are the ounces you can actually mobilize without delay. When accessible supply tightens, the system starts bidding for immediacy and rent rises. Now let us walk through the most common reasons you get a flare, so you do not misread the signal and talk yourself into a story that is not there. The first flare driver is balance sheet compression. Certain windows make institutions cautious. They lend less. They intermediate less. When intermediaries step back, the market loses lubrication. Borrowing gets expensive for a moment. Then it eases when the window passes and balance sheets loosen again. The second flare driver is a positioning shock. If a lot of participants try to do the same thing at once, demand for short-term metal can spike even if the underlying availability is fine. It is a crowd moving through a narrow door. Once the crowd passes, the door looks wide again. The third flare driver is collateral stress unrelated to silver itself. Funding markets can tighten, and that tightening can show up as higher rent in many places, including metal lending. When funding conditions normalize, rent can fall even if nothing about the physical metal changed. The fourth flare driver is a one-off delivery pressure, a settlement spike, a deadline, a temporary mismatch. It can be loud and then disappear. A flare matters because it warns you that the system can tighten quickly, but a flare does not automatically mean a structural shortage. Now let us walk through what creates a fire. A fire usually means a real bottleneck in mobilizing deliverable metal. That can come from location mismatch that cannot be fixed quickly. It can come from form mismatch, where the right bars are scarce even if total ounces exist. It can come from concentrated holdings, where large stocks are not being lent. It can come from logistics friction, where moving metal is slower and more costly than the market assumed. It can come from a sudden increase in demand for deliverable supply from industrial channels that do not care about narratives. Only delivery, and when it is a fire, it tends to show up across the confirmation stack. Rent stays high, near-term spreads stay stressed, physical premiums stay sticky, delivery terms tighten, dislocations persist. Now we are going to do the part that most people never do, the part that separates an emotional watcher from a professional observer. We are going to ask who is forced to act when silver tightens, because in every market, there are actors who can wait and actors who cannot. The actors who cannot wait are the ones who reveal the truth. An industrial buyer cannot wait if a component shortage stops a line. A dealer cannot wait if they promise delivery. A short seller cannot wait if they must deliver. A clearing system cannot wait if settlement must occur. These actors do not have the luxury of saying, I will reconsider in a month. They have obligations. So when you see rent spike, you should imagine a clock ticking somewhere in the system. Someone is paying to buy time. Someone is paying because time is not free anymore. Now, there is a painful truth you need to internalize if you want to stop being shocked by silver. The spot price is not the price of silver. The spot price is the price of paper that references silver. The price of silver you actually experience depends on form, location, and timing. That is why two people can both say they bought silver today and mean completely different realities. One bought exposure at a clean price on a screen. The other bought metal with a premium, a delay, and strict terms. When the system tightens, that gap widens. And when that gap widens, the market psychology changes. People stop asking, is silver going up? They start asking, can I get it? That is the moment a normal market becomes a stress market. Now we are going to build your final checklist. The one you can actually use without turning your life into a full-time analyst job. If you see a rent spike in a major hub and you want to know whether it is a flare or a fire, you run these questions in order. Question, when did it persist? If it fades fast, you treat it as a flare unless other signals scream otherwise. Question 2, did the near-term curve in spreads confirm? If the market is truly paying up for now, you should see now being priced differently from later. Question 3, did physical premiums and delivery terms confirm? If physical does not stay tight, paper stress can be temporary. Question 4, did dislocations persist? If the system can easily move metal to close gaps, stress should ease quickly. Question 5, did accessible inventory proxies deteriorate? Not total inventory, accessible inventory. If you get yes answers stacking up, you are watching a fire. If you get mostly no answers, you likely watched a flare. Now, here's the part that will save you from the biggest mistake people make after they learn this. A fire does not guarantee a straight lineup. In silver, fires often produce volatility, not smooth trends. The market can be tight and still drop hard because leverage can unwind violently even when physical conditions are strained. The paper market can flush before the physical market gets to speak through price. So the right way to use this signal is not to treat it as a promise of instant profit. The right way to use it is to treat it as a warning that the market stability is changing, that is valuable whether you are bullish or bearish, because stability determines how fast you can be wrong. Now, let us bring all of this together into one clean narrative, because you are not here just to collect concepts. You are here to be able to explain what you are seeing. When the rent to borrow silver spikes in a major hub, it means immediacy has become expensive. Immediacy becomes expensive when the system cannot mobilize enough deliverable metal without paying up. That can be temporary, driven by timing and balance sheet behavior, or it can be structural, driven by real bottlenecks in location, form, willingness to lend, and delivery pressure. If it is temporary, it fades quickly and leaves little evidence in the physical chain. If it is structural, it persists and shows up across premiums, spreads, and delivery terms. That is the whole story. Now, let me give you the final payoff. The line you came for, because this is the reason London matters, even if you never trade in London. Silver does not explode when the world runs out of silver. Silver explodes when the market runs out of deliverable silver right now. And deliverable right now is not a global concept. It is a venue concept. It is a form concept. It is a timing concept. So a stress signal in one hub can lead the entire market, because the hub is a junction where obligations settle and where pressure changes propagate. That is why the most honest warning signs often show up as boring numbers. Most people ignore rent, spreads, delivery terms, premiums. These are the language of a system under strain. And if you learn that language, you stop being surprised. You stop being the person who wakes up to a violent move and asks what happened. You become the person who saw the pressure building and understood that the hallway was narrowing. Now, a quick favor before we close. If this episode helped you see silver differently, subscribe. This channel is built for exactly this, teaching you the plumbing behind the price so you can stop being pushed around by headlines. And share this with one friend who keeps sending you silver posts that sound certain but explain nothing. Because the fastest way to get smarter is to replace drama with mechanism. And if you want to help steer the next episode, leave a comment with the exact signal you want me to decode next. Lease rates, spreads, warehouse categories, premiums, or something else you keep hearing about but never see explained clearly. Now we end with the simplest truth in this entire market. Silver is not just a metal, it is a system, and systems do not fail loudly at first. They fail quietly in the rent, in the spreads, in the terms. If you can read those, you will see silver stress early. If you only watch spot, you will see it late. And in silver late is expensive,